it seems like they're just setting everything up for like a 2018 style flattening out, October drop, Christmas rally into the new year. It's like watching history repeat itself. Good morning, everybody. It's Tuesday. Do the darn thing all over again. Japan up 4% this morning. Keep your eye on them tonight. We're going to get trade goods data and could get a little unwind of that. UK down about 0.75%. US markets are basically flat, up a dime, waiting on data. We're supposed to be waiting on data yesterday. We saw how that went. And I continue to see a lot of people attempt to do, say, like 0-day trade stuff. And just a quick tip, right? When you've got these big, massive bars that are outsized compared to all the other bars, it's just a really big hint that you don't want to try to do any sort of edges or ranges like credit spreads along the weekly expected move and the day's edges, because it's just going to run you over, right? You want to have very clear reversals, something like this, where it's already set the edge so that you have a low edge and a high edge, or at least, you can leg in one edge and the other edge. And don't just step in front of a freight train. You're going to get run over. We have broke records on how fast we moved to the downside and then how fast we recovered and how the recovery is still going. And I mentioned yesterday about a very bullish setup. It's a topping pattern that during the pullback just shoots all the way back up without setting a higher high along the way. It just goes all the way back up to the top and breaks the top. Until this pulls back, we're in the middle of that pattern. We've got two Fed speakers today. One is at a university. That would be Bosick. Don't really see that one as too impactful. It's the other one need to watch for. Barr is going to be talking about banks and bank policy. Could see a little bit more out of that one. But either one, as I've mentioned before, if they're talking live, meaning it's not a recording, if they're going to do Q&A, if there's a chance that the algos could misinterpret what they say, or a reporter can misinterpret what they say, or they can just straight up say something that was out of context, out of line, wasn't supposed to be said. They can cause violence. We've seen it happen before. So we just want to prepare for the worst, right? That way we're ready for it in case anything happens. Otherwise, we do have Japan info tonight. And we've got some auctions. It's not the big one, but we got the 20-year tomorrow. We're going to get FOMC minutes. We've got Powell speaking Friday. There's still a lot to expect this market to slow down and wait for. But so far, we're not slowing down and waiting on anything. And it is a low volume environment. And I get it, newer traders don't grasp the threat here. But in a low volume environment, it doesn't take much buying to move the markets. And there is buying, massive buying, corporate buybacks. The CTAs are grabbing it hand over fist, and they have to buy, right? Those vol funds, they don't get to pick and choose. They're non-discretionary. They have to buy when volatility hits a certain level. Those buybacks happen on a schedule. It's not like they're choosing some optimal time to get in, right? So there's just massive money flowing into the market from those non-discretionary traders in the lowest volume environment of the year. It's summertime, or so August It's always the low volume time frame, and that can move markets violently way farther than you think they should move or could move. Looking at my scanners this morning, just kind of getting a look around. The bull scanner was lit just full of names, and there's semiconductors, the Mag 7, tech stocks, but the bear scan is almost empty. A couple of staples, utilities, and energy. Defensive names are bearish, and offensive names are bullish. And it's a long list this morning, which is exactly what you would expect in a bullish environment. Now, we don't have Spot Gamma's AM notes yet, but we do have the PM notes. And one of the things that they were talking about is that dispersion trade. The idea that stocks are moving like crazy, but the indexes aren't moving as much. And I mean, we're looking at the SPX. It's moved from 55 to 56 in 3 days. It's a pretty good size move. Still has a 75-point ADR. It's an average daily range. So it's making moves, but stocks are moving even more than that. So while we continue to think that the indexes are going to call timeout and take a break and take a breather from this ripping recovery, they don't have to. So far, they're not. And we're still getting a lot of that buyback and CTAs and vol funds that have to buy in that low volume environment. And it's just continuing to go. Jackson Hole typically is a sell the news sort of event. It doesn't mean that we're going to definitely sell off, but when you start mapping out what we've done, say over the past 5 years of Jackson Hole events, selling off afterwards is kind of the norm. There's also the later part of the year in an election year sell off. There's that one too. So a lot of reasons to believe that the last part of this year is going to be weak, sideways, negative, but we don't have that yet. If we go back to mid-July, the week where we topped out and rolled over, there's a point of control there. Let's call it 56.50. It's pretty close to that. Definitely want to keep your eye on this place. If we get close enough to it to hit it, or if they front run it. You can see we're almost there. 56.32 is a cog line. We're at that spot. 56.50 is the point of control that I just marked. After that, we're back up into 57, and then we'll see, right? We got to set an equal high, and or we have to set a new high. Now, I had been mentioning on when we're doing price analysis called the pure price method that we needed to get past that level right there, and we did, right? But we still need to do one of two things: run all the way up and set that equal high, or pull back, which at this point is going to give us that higher high. We have to pull back and we have to set a higher low, which shouldn't be a problem, and then run up and break this high and challenge that high. So we're either going to pull back and set this level, or we got to go up here and test this, one or the other. Getting through this zone was a big piece of what everybody was waiting on, because that was going to be a defining characteristic. But we made it through there without pulling back and setting an equal high, which would have been more of like a cup. Then we would have been looking for a handle and a continuation. We didn't get that. But there is still the idea of a sell zone when you have a cup and it doesn't pull back and instead it overshoots. Well, that's not a cup. That's a double top. And that's what this is right now, is a double top. Double tops are bull traps. You've got to convince the bulls. Otherwise, you don't trap them. And the only way to convince a bull is to break out through the previous pivot point into a high above that pivot point. So we've got the bulls here. When you have a double top and you overshoot that previous high, how much farther past that high do we have to go before we consider that, you know, maybe it's not a bullish trap and it actually is a continuation breakout? It's not a perfect way to do this, but my answer to that is to use the 111 and the 1236. Now I moved it all the way down to the low end of this wick, but we don't have to. If we want to, we can tighten it up a little bit. That would be 5647, which is the same thing that we have over here, 5648, that point of control. Or we use the full low down here, and that's 5654, which overshoots 5650. And liquidity resides on the other side of the pivot. So if that is the double top that we're measuring, this is the breakout that we're looking at. And that zone into the 111 is where liquidity is at. It's where we expect sellers to step up. And it's what we want to be mindful of, right? That's the level that we have to get through. Unfortunately, just getting through 11 doesn't mean that we won't sell off. We still have to get through this high back here, which also happens to be the 1236. It's both of those. So you can see the issue, right? We're still in that sell zone until we get to the other side of it. It's still a threat. Once we do get all the way back to the top, then we have the same setup again, one big massive cup, and it'll either tag it perfectly and pull back, which gives us a cup and handle, or it'll overshoot that previous high and give us a double top bull trap that will yet again measure and lay out a 111 and a sell zone and see if we can get through that liquidity. We can see the central pivots working their way up each day higher than the previous day, some with a larger gap than others. But every one of these higher than the previous day's high. There's a very narrow channel on this day. This is what we're looking for if we're trying to find one of these big breakout runners. Wide days imply that breakouts fail and that we're really not going to go anywhere. Narrow days implies that if we do break out, we're going to stick it and keep going. Now, this day wasn't as narrow as I would have liked. Same thing with yesterday. It's not as narrow as this one, or even so narrow that you don't see the yellow lines at all. Today is wider than yesterday, and we're getting closer to that point where we expect the market to pause and wait for data. Next week, we got NVIDIA on Wednesday, and that's going to be a real big hurry up and wait too. The last NVIDIA earnings was on Wednesday, and we spent Monday and Tuesday in a really tight range. It was like 35, 40 points for the ES. We went nowhere for 2 days. So far, we don't have that. We have a slightly bigger channel, and we're still waiting for today's Spot Gamma Founders Note, which I noticed they just came out with, to see what their zero gamma level is, the Spot Gamma Index. We want to get that number to have an idea if it's in the positive or in the negative. Yesterday, it was at positive 1 point something. If it's a positive number, it implies that breakouts don't generally have legs, and that we're more likely to do, one of these sideways days. So if it's positive, this is what we expect. If it's negative, this is what we expect. It's not perfect, right? It just gives us an idea of what the market should move like. So looking at today's Spot Gamma, it's basically where it was yesterday, 1.8, slightly positive. And we broke out and ran yesterday anyways, because it doesn't mean that we can't break out and run, just that we don't expect those kind of follow through breakouts to stick. That was a nice Busby, by the way. I haven't mentioned Busbys much lately, but it's a phrase that I came up with. When you have price in a range, testing against that range, and then it finally breaks out, what price generally does, doesn't always do this, but what it does a lot is after a resistance level has been broken and we come up out of it, price will come back and retest it and validate that old resistance as a new support before beginning a trend. It is one of the defining characteristics of a new trend beginning after a market has been in a range. Well, saying all of that gets old when you have to say it over and over and over and over again. So I came up with a phrase, Busby, that generally just means we were in a range, we broke out, and we tested that old resistance as new support. I've done videos on this, I've taught the concept, but really there's not much to teach. It's just the idea that price generally retests resistance as a new support level. So far this morning, we've got an MDP. That's a missed daily pivot. We haven't hit this pivot yet. Price generally hits the pivot 80% of the time. So the fact that we're not hitting it implies we're doing a little bit of the unusual. It's above yesterday's pivot, completely outside the range, which implies bullishness, and we're above it, which implies bullishness. But we are sideways in a really tight range. It's about 13 points, give or take. And it's been a run of extraordinary distance. The rate of change is really steep. These are violent moves, and it goes back to we are still in volatility. We're not far enough from the weekly pivot to be a concern yet, so that's not an issue. And one simple defining characteristic of volatility is our daily movement is still exceeding what we are projected to move by 100%. Right? That's like having a car that's supposed to get 10 miles at a gallon and you're suddenly getting 20. We're moving twice as much as what we should be moving. So this is why we don't want to just blindly put on iron condors and credit spreads 0 days in this environment. We need clear examples that it's going to be a sideways day. And when we broke out yesterday afternoon, And especially after we got that Busby, it was clear that it was not going to be a sideways day. It was a sideways morning. And that's why we do a morning iron and an afternoon iron. Once we got that breakout, that was it. There was no more sideways to it. It'll be the same thing today. We're expecting sideways. And as long as we stay within our own Globex range, then we're still sideways. As long as we stay within yesterday's range, we're still sideways. Staying inside of our own Globex, that's going to be hard because it's a really tight range. But staying inside of yesterday's range, that's a really big range. You would need to put on a really wide iron, which means you're not going to get very much credit, and you can still get run over, right? You can't get far enough away from price, which is why putting on the iron in this environment for a 0-day trade, you got to have more than just the idea that you want to put one on. Because we have a 100.21-day average daily range, the distance to the red lines from where we opened in the Globex is 50 points in each direction. So we've got a 56.80 to the upside and 55.80 to the downside. That just covers the ADR half. All right, we got typical volume this morning. It's at 48. That's a little low, but we saw, 40s recently. It's not that bad. It does highlight, though, that we're in that low volume environment. Yeah, I got it shared now. You can take a look at it. You'll get to see it before me, but I'll read it after. We're still above all the moving averages, the volatility trigger, 0 gamma, 3-week, 10-week, 10-day, 20-day. We're above everything, right? So from a moving average perspective, and even from the options levels, there's only one thing overhead that we really have to deal with, and that's the new call wall at 57.75. Ten-day, 30-minute volume profile since we left this zone behind, that 55.75 area. It's not likely that we're going to see the point of control move up to that level for at least a week, because we need time for this volume down here to dissipate, and or we need to sell off back into that zone and build up more volume here until it becomes the point of control. Base case argument, I'm still looking for that 55.75 to become the point of control, one way or the other, either because we sell off into it or because we lose this volume back here and there's no other node with that much volume, and that just by default becomes the new point of control. If we're maintaining above it and that becomes the new point of control, then it's a new structural level to lean on for a continuation. But we have to get there. If we sell off into it and then we get below it and the week goes by and we lose this volume anyways, it'll still become our point of control, but we'll then have it as a resistance that we have to fight through. So 55.75 is still an important level. And it's where we expect that point of control to go. But it will take at least a week to bleed off this volume from down below and get it to move. It would happen faster to get it to move if we just sell back off into that area and build up more volume there. We wiped out that 5611 cog line VPOC yesterday. Finally made our way through it. We have a new VPOC from yesterday. So we'll just take the line and move it down. $5,600. Nice round number. Yesterday's point of control. It just highlights how much round numbers matter, right? It's where the greatest amount of trading took place yesterday, is right at that round number. Typically, we would expect volatility. We would expect volume, trading activity, liquidity to be on the other side of that pivot. So 5602, 5603, that sort of thing. It's interesting that it was right on the money, 5,600. Either way, in a pullback, we'll expect to test that and see those traders pop back up again. Just from traders' remorse, we'd expect to see that activity show up. But there is the cog line, 5611, and we're at the other cog line, 5632. So we do have structure to deal with. That really tight range this morning, just it shows up clearly in this environment. It's a crazy tight range. We don't talk about it often, but there's an indicator called the RSI Laguerre. And one thing we learned from using that is how a market gains energy. Energy is a weird word you don't normally hear in the trading space, right? It's usually momentum and inertia, trend, but energy, when it comes to a market, one, how does it gain energy? And then when it's making a move, is it moving, spending that energy, or is the move building up energy? The analogy would be if you take a ball out in the yard and you throw it, you put energy behind the ball moved, and as it's moving, it's slowly losing energy and it falls and hits the ground. Take a ball and drop it off of a very tall building, and as it falls, it builds up more energy, right? It's getting faster and faster as it falls, and it's gaining energy. Well, markets are the same way. Sometimes when they make a move, it's burning energy. Energy is being used to make the move happen. Other times when it makes a move, it's actually building up energy. So that's one way that a market can get energy, is by making a quick reversal. If it was going down and it makes a quick reversal up, that'd be getting energy. If it was going up and makes a quick reversal back, that again would be getting energy. But the other way that a market gets energy is by going sideways. The longer it goes sideways, the more energy that it builds up, like charging your cell phone, right? Got a full battery. Well, with the RSI Laguerre, you could see if we're at, I think it's 60 plus 60 is a full battery, full tank of gas, however you want to see it. So, when we're in these sideways quiet periods and you think the market's not doing anything, yeah, it is doing something. It's building up energy for the next move. Now, back in the day before we had the RSI Laguerre, we would just look at things like the squeeze indicator, right? Because that would imply a impulse strong move in one direction or another too. Either way, whether we understand that there's energy behind it or not, a sideways market is the calm before the storm. Like back here when we went sideways in a really tight range all night, and then we made a sudden and violent move. Or here when we went sideways for half the night, we made a violent sudden move. Kind of get the idea, right? Sideways, sudden violent move. Yeah, like that. Yeah, the RSI Laguerre. I mean, I've in my workbook, I've probably got 5 different versions of it. I think it's on TradingView too, but it'd be a custom indicator. You'll have to, find it in the community. It won't be just your basic everyday Laguerre. The Doc Severson wrote a couple books on it, right? If you want to go that route. Or, yeah, just leave it at that. So we are really close to the weekly expected move. This is how far the market was expected to move in the entire week. We're getting close to that distance after just a day and a half. And yes, the day is half done already, right? I know it doesn't feel like it. You just crawled your butt out of bed, but the day is half done. Markets opened last night at 6 o'clock. It's now 8 a.m. We're past the midpoint. And we're already really close to the edge of the weekly expected move. Another 20 points. We are 2.5% above the 10-week. That's the sweet spot. It's kind of where we want to be, between here and 4%. We spent a good part of 2023 and 2024 in this zone, and that's exactly where we want to be. Looking back before that sell-off in 22, if you look at 2021, sitting between 2.5 and 4, well, actually a little above 4 because it was so strong of a run back there, above 4%. But above 2.5 is a good place to be. We're not overbought. We're not overextended, not on that weekly time frame. So as much as this may have seemed like just an exceptionally violent rally because of how far we moved and how fast, the rate of change on the higher time frames on the weekly, we're not overbought. We're not overextended. We haven't traveled too far. We're not ahead of our skis. Use whatever phrase you want. If we're only 2.5% above the 10-week, then it does not owe us any sort of mean reverting pullback on those higher time frames. Now you get into something like the daily, and we're certainly at that point where we would expect a pause and or some mean reversion. Done a lot of mean reversion trading over the years, and even just a lot of mean reversion study. And one thing that's dominant in all of that is not just how far from the mean we are, right? Which is always an issue. It's how fast did we get that far from the mean? So a classic example of the mean would be a 10-period moving average on a daily, right? This is a pretty common number to use. And when you've got a market that's just grinding at, 1.5% away from the 10 or even a 2%, it'll just maintain that all day long. But when you get really violent, very sudden moves, that's when you tend to get those reversions. There's plenty of examples where we get a distance away and we just hold it and hold it and hold it and hold it, and it's not a big deal. So in the current environment, when you see how far we've moved from the 10 on the daily, there's no other way to look at this except to say, oh yeah, we've hit some sort of maximum distance. But when we've had that happen before, we need a correction, right? That's what the market is in need of, is a correction. So once you've moved too far, too fast, you can go sideways while you wait for the 10 to get caught up, or you can pull back to the 10, either one. So if you overshoot the 10, you get too far away, go sideways, and you give the 10 time to catch up to you, or sell off back to the 10, or a little bit of both, right? So we're overshot. Clearly, we're overshot. It doesn't necessarily mean we're going to sell off. We could just drop back down and hold this range and wait for the 10 to get caught up with us. It looks like it takes about 6 or 7 days on average, 4 to 6 days. Sometimes when we're waiting on data, it can take 2 weeks. It does not immediately imply we're going to sell off. But we are at that point on the daily where we don't really want to get any further away than this. Notice some of these big spikes back here into 3 and 3.5%. It was during 2022's bear market. And those were 3% spikes above the 10-day in a bear market. Because in a bear market, you can get some very violent, very extreme moves. And this was Jackson Hole 2022, when Powell told the market, higher for longer, suck it up and take it, and dropped the mic. Well, we'll see, right? See what he does this time. There's August of 2023. No, that's 22. Where's August 2023? Here. Jackson Hole again in through August, September, October. Well, here's August, September, October 2022. Starting to get the idea. Yeah. Even back here in that extraordinary 2021 market rally, August, September, really by November, we were trying to get back out of it. Or through October, we were coming out of it. And by November, we were in new highs again. But it's just a little too early. We're not even done with August yet. We still need September and part of October. Now, it's possible that this is one of those years where we don't do this, that we get back to the high by September, and then we're in the new highs, and we do something like this end of year back in 2021. The bull list is still just completely filled up this morning. AMD, Tesla, Google, Microsoft, PayPal. I mean, all the Mag 7 is in there, Amazon. And then there's some semiconductors, MU. We've got some communications, entertainment, even some banks. NVIDIA's in there. Transportation. So individual stocks, those are the ones you want to see for a continued market rally for sure. You just have to be aware of how far we've run, because you don't want to get a rug pull, right? There's different kind of gaps in the market. Gap up, gap down, breakaway gaps, exhaustion gaps. an exhaustion gap at the highs can give us a midpoint or a flip point. None of these look bad though, compared to, okay, well, Apple, we'll use Apple. So this doji was yesterday's close on Apple. Inside day, nice recovery back up after breaking the downside of yesterday, closed inside the range. Apple's up this morning by a couple of pennies, right? Barely up at all. What we would be looking for if this was going to be an exhaustion gap and a rug pull would be, say, a rally up, break outside of yesterday's high, kind of like how we broke outside of yesterday's low. And we had that recovery back in. Do it the other way this time, that we rally outside of yesterday's range. Maybe we test Friday's high and then we roll it the other direction. And not just on Apple, right? But on all of those that have something that looks like that. Things that are down this morning, the China ADRs, BABA, Baidu, JD, PDD, XPEV, NEO, that group. Things that are up, gold miners, nat gas, Bitcoin. Bitcoin proxies were getting slaughtered yesterday. It makes sense that they're getting a little bit of a turnaround over the last 5 days. Even with this 3% move today, they're still down 3% over the last 5 days. So sure, they were down 6%. They rallied 3% this morning. They're still down 3% over the last 5. If you're looking at breakouts though, right, tech is on the second day of breakouts. High yield bonds, gold miners, growth, but also your China ADRs and healthcare. First day of breakouts, Mag 7, S&P 100. Yeah. So that's a big move on the China ADRs. We've said for a while now, right, that it's going to take some time before looking at BABA and Baidu as anything that is a good play. And there's nothing wrong with bottom fishing and trying to pick them up from the lows. And if you're in KWeb from 25, then you're still good, right? But if you were in KWeb on that breakout of, 26 and a half, then, you're probably regretting it right now. So you're close to break even already. This is still just junk. So the Bitcoin proxies all look good this morning, and depending on which ones you're looking at, like Robinhood, for an example, it's still just a continuation of green. But some of the others, they had the beat down, and they're more of like a bear pennant than anything else. So the Bitcoin proxies, sure, they're getting a little bit of movement, but they don't excite, and they're certainly not looking good. That move in silver, though, silver, gold, gold was hitting records yesterday. Pot stocks are up. It's not really one that we want to see for a good rally, but it's there. and then the Mag 7 and a lot of tech. So watch the flows today. We want to see that same bullish enthusiasm in the flows that we had yesterday. We want to see that continue today. You know, looking at the weighted AD yesterday, we stayed stalled until after lunch around that 250 level, that line in the sand that I use all the time. And then we finally got above it, and into the afternoon we expanded, but not into the, 800, 900, 1,000 range. We barely got into the 500s at the end of the day with a significant push. But look at the tick. We were almost dominantly in the green yesterday. Barely spent any time in the red yesterday. So it'd be same example today. We want to see the ticks maintain this solid green range. If we're looking for breakouts and expansion, it'd be nice to get a plus 750. We didn't get one yesterday. Of course, we didn't get a negative 750 either. But that's just a sideways general lazy day where there's just a serious lack of flow out there. Low volume environments, markets can make exaggerated moves. If it's going to be a rug pull today, which I'm not necessarily thinking that that's what we're going to get. We got to get to the red line, right? We didn't get to that red line Friday. We didn't get to the red line yesterday. How many days can we go without hitting that red line before we hit the red line? I don't have an answer to that, by the way. I'm sure that there's some kind of countdown to it. We have to make a move like that at some point, but we made it so wide that right now it's up to 102 again. You know, a month ago, that was like 80 points. Now it's 100. If we get that rug pull, it'll start with breaking our own Globex range. If it's an upside breakout, just like I said yesterday, if we break that range up, then we go to the ADR. If we break that range down, then we go to the lower ADR. Well, we never broke that range low, right? And when we did finally break that range to the upside, we got a perfect Busby off of it and then a run towards the red line. We're in the same boat all over again this morning, only it's a narrower range than it was yesterday. Keep your eye on the news, watch the clock. Everybody be careful, be safe. I'll see y'all tomorrow.